Welcome back, everybody, to the Dave DY Show. This installment, and I think you're going to enjoy it, is on finance. Pretty important subject. I'll probably say this again in the future, though I'm telling you right now, this is for the last time I'm going to say this for this year, being that it's June 2019. We are headed for some issues in your personal investment, in the national and the global economy. The bond market is inverted. The stock market in the last 9 recessions predicted 5 of them, meaning the market saw that there was issues and it dropped appropriately. Ownership equity of companies stayed at a proportion, but the valuation of those companies significantly contracted. 5 out of the last 9. Oh, that's not very good odds. That's 50%. The bond market predicted 9 out of the last 9. When the bond market inverts, the long-term securities, the long-term instruments in the bond market 10-year up have a lower rate than the short term. That's insane, because you're always supposed to have a greater return the longer you hold that instrument. So right now, the 10 years are below the 1 year and the 5 years. And they call that a bond inversion, an interest rate inversion. And the way that we usually deal with that is a correction in interest rates. We lower them. The Fed lowers interest rates. The Federal Reserve. Well, the interest rates have been extraordinarily low for over a decade, ever since the 2007 global issues. So that's not going to be the case here. And these corrections should have been managed by the market, not by changing rates. So we've bastardized what should have been corrected by itself with failure of organizations, right? With debt that became due, with the valuation of instruments, bonds, stocks, that is overinflated, collapse and go under. Banks close. Major corporations close. They become insolvent. They're overvalued. They're not making profits. They're not surviving on their own. We've jury-rigged the system so those things don't occur, or they didn't occur en masse on a global level, and cause an entire depression, recession, depression, global breakdown. Well, we're headed that way again. We're going to go into another recession here. We've got this bond inversion, and it always predicts a recession. So you better be prepared to have a decrease in the market, to have your instruments, your investment, your retirement, your savings, all of those things potentially impacted. Be aware, it's coming. As long-term instruments, bonds, have a higher yield, a higher rate of return, the greater you invest in them. And that's with any tool or any instrument, right? Any financial instrument, usually. So if I invest in a 10-year, my expectation is that my yield will be longer, right? I'll make more money. Right now, in the United States, that long-term bond, 10 years or greater, has a lower yield, interest rate return, than the short-term bonds, 1 year, 5 years. That's a problem. And every time that that's occurred, there is a recession. Sometimes it turns into a depression or a major global downturn. Sometimes it doesn't. It's a recession and then we come out of it. Right now, the stock market is at record highs. Corporate valuations, corporate IPOs, technology stock, the FANG, Facebook, Apple, Netflix, Google, right? All Alphabet, all of these corporations, Zoom, Lyft, Uber, Levi Strauss, all these IPOs that have gone off, they're highly, highly overvalued. 50, 60, 70, 80 times overvalued. Meaning the stock price would have to be multiplied, would have to be divided by 80 to come to the actual valuation of what that company is times the number of outstanding shares. So if Apple's worth $100 million, 100 million, and it's not, it's worth billions, right? Trillions almost. Apple and a couple of the others. I think Google or Amazon with Bezos have gone into the trillions. That's the actual valuation, but the price and the number of shares that are issued shows it as a valuation of 20 or 23 trillion. And again, that stock reflects the potential for growth. It reflects the inherent valuation of the intellectual property, the uniqueness of the product, the long-term life of that company and the product lines, and all that stuff. The intellectual management and staff, the chairman, the president, the heads, the things that they know will drive the future, innovation, all that shit, right? There ain't a company on the globe that should be valued 60 times whatever its actual worth is, anywhere, ever. And that's a common trend in the current market. So, as I said, 5 out of the last 9 times the stock market dropping showed that we were heading toward a recession. 4 times it didn't. It was healthy as all get out, and then the bottom fell out. The bond market has always shown through this inversion curve, through this long-term instrument being less valued than the short-term instrument for yield, has always shown a recession coming. It's speculated it's going to be in 2020. If, this is not the US alone, this is globally. If you go to Europe, they're UK, Germany, Spain, the entire EU, they're in a much worse strait. Right now, if you want to buy a bond in Germany, you actually have to pay the German government who's issuing that bonds money to buy that bond. It's not you giving money so that your bond has a value. Meaning, you give $100, your bond's worth $100 face value and an interest rate. In Germany right now, if you want to buy a $100 bond, you pay $103 for that bond and it's worth $100. Their yield has such a negative on it that you, the purchaser of the debt, you're paying for that bond to loan money to the German government, you have to pay them a surplus because the value of that bond is so far below 3%, almost 4%, what it will sell for face value. It's in the negative. It's fucked. It's bad. You gotta pay them to get rid of your bonds because your bond's worth less than what it is at face value. And that's the long-term yields, and that's really bad. And Italy is loaded with debt with these bonds, and Italy is about 4 or 5 or I think 6 times larger than Greece as an economy. And if we have a bond issue where this thing actually grows to scale like it has in the past, and Italy goes into some kind of debt, it will cause the EU to collapse, which will cause the US to collapse. We're in a very calamitous situation right now. Very calamitous. Italy has trillions of dollars in outstanding bond debt. It's revving up to be really bad. So my take to you, keep your eye on your investments, keep your eye on your retirements, stay relatively liquid, be very, very cautious, be ready to pull the trigger so that you cash out anything that you have. It's coming. We're going to have another meltdown, global, American, sector-based, stock, whatever. You better be prepared. And I said it. This is the last time I'm saying this. It's not. I'll probably bring this up later in this year as we get closer to whatever this thing is. Keep your ears on. Dave Dewey Show out. Subscribe, comment, like, share.